Hey folks, welcome to Quantsapp and welcome back to yet another video. In this video, we will understand a few positional option trading strategies. Okay, and the thumb rule for today's video is going to be about improvising reward to risk of your option strategy. I'll explain you why you need a better reward to risk in your option strategy. Okay, so now the thing is, when you are trading in options, okay, why you are trading in options? Ask yourself a question: why you are trading in options? If you wanted to achieve the same reward to risk, which is 1:1, you could have traded the instrument in future. Let's say your forecast is that the market will go up, right? You buy a futures, which is much more simpler instrument to trade as compared to options, right? Wherein nothing is affecting, no, there is no theta decay, no vega component, no option Greeks are affecting it, right? Why don't you trade futures if you want to achieve 1:1? But idea of coming to trade options is that you want a better reward to risk because of obviously the dynamics which options carry along with them. So let me explain you that. Let's say you took a trade in futures with 1:1 reward to risk. That means when you win 5,000. When you lose 5,000. Okay. So now if I just take few trades, okay, let's say I'll take 10 trades, okay, let's say 6, 8, and 10. Okay, so what is what is the difference, right? What we are achieving out of it? I'm saying that you will fail in the market once and you will win in the market once, which is again a rare scenario. Your strategy might not give you 50% accuracy, but I'm still saying, let's say you're getting a 50% strike rate, okay, and you are having 1:1 reward to risk. Okay, now see the problem here. Net you are just paying brokerage and you're not earning anything, you're not taking anything away from by doing this. So the reason why I believe you should start trading options is to optimize this, to tilt that mathematical game in your favor, right? To start churning that money from mathematics. So I'll show you how. Okay, so now the problem with options is such that there are so many strike prices to choose, and there are so many strategies to build. So we don't know which combination will give us the best output. Let's say I have a bullish output on Nifty, a bullish forecast on Nifty, or a bank Nifty, whatever the instrument is. There are over 180 combinations and permutations. Okay, 180 million combinations and permutations, which can be executed to tackle that forecast.
Optimize your options trading using Quantsapp. Click the link in the description box below, apply code YTUBE and get a 2 days additional access to all the advanced option trading analytics and be a data-driven trader with Quantsapp. Thank you.
That there are 180 million different strategies which can be done to tackle a forecast, to trade a forecast. But is it humanly possible for us to go ahead and do that? The answer is no. So for that, we will use the optimizer tool in the application. So now optimizer tool is there on our mobile application, desktop and Android. I would highly recommend, if you're trading in options, this is something what you need. Reason: a better reward to risk, and most important of all, what the tool will do is it will add a statistical edge and a mathematical edge to your forecast. Okay, so the link would be over here somewhere in the I button. You can click it from there, and let me just guide you through. Okay, it is very simple. So first, select Nifty. The price would be populated automatically. Then you need, so see, optimizer is a tool which is designed to build a strategy. For that, we need to be sure about what our forecast on the instrument is. So there are various ways through which you can do it. I will not repeat it. It is futures built up, it is technical indicators, it is open interest. You can use n number of ways, but after having that as well, we don't know what to do in options, right? So for that, optimizer is the tool. Let's say I am bullish on Nifty. Right now, market is at 17,945. So I'm saying that my forecast, okay, or my view is till next Wednesday, okay, wherein I'm feeling that the market might go to 18,500, okay, and I'm feeling that the market might, if 17,500 is broken on the downside, I am stopping out, okay, I am getting stopped out. So this is my forecast that I'm expecting of roughly 500 points up move and roughly a 500 points or 400 points down move. This is my target and stop loss. Now for this view, manually, do you know what to do? The answer is no. Somebody would say call option buy, somebody would say short a put and bull call, bear put. There are so many combinations. So now the tool is asking us optional parameters. That means what is the type of capital you are ready to deploy on one strategy. Okay, this is the capital you are ready to deploy on a single strategy. Not it is not your portfolio size. It is the capital you are ready to deploy on this. So I am saying that roughly around 5 lakh rupees is the capital I am ready to deploy. Risk, that means if my stop loss is hit on my target date, okay, if 17,500 comes on 22nd of Feb, I'm ready to take a hit of 5,000 rupees maximum. Minimum strike, maximum strike. So these strikes prices are the range in which the strike selection will be done. It is not the range of market, or it is not the range in which Nifty will move. Instead, it is the range in which the strike selections will be done. That means the algorithm will not recommend you any strike below 17,300, and it will not recommend you any strike above 18,700. Okay. So now there are two options, which is limited risk strategy and all strategy. So all strategy will involve all it will involve all the strategies which are even having undefined risk, but limited risk, as the name suggests, it will only show us the strategies which are involving a defined loss. Hit apply, and here you go. You have the best option strategies, okay, to tackle this particular forecast. I will show you how to choose one of them from these. First of all, I'll get to see the name, okay, the optimality of the strategy. Okay, so this is based on reward to risk. It is basically based on the parameter that you selected. Okay, it is based on this. If you would have selected reward to risk, whichever strategy gives you the best reward to risk, that would be the first. Okay, so now according to this, long call is the most optimal strategy. The reason is that it is giving you a better ROI. It is a better I would say it is a better return on investment. Reward to risk is also better, and also in a simple long call, okay, the algorithm which has identified, it is matching the best parameters. That is the reason it is ranked as first. Okay, and it is the most optimal strategy. Okay, but how will you select from here? Now long call may the problem is that the theta decay happens a lot, right? So instead of that, we can select something like a bull call or a bull put spread. So wherein you will get to see target profit. If your target is achieved, how much profit you would make. And also there is something known as stop loss, which will show you how much loss will you make on the stop loss if 17,500 comes on 22nd of Feb. So now if you just observe these strategies, all of the strategies, the stop loss, you're not making a more loss than 5,000. The reason you give input about, you can give any inputs, right? But don't give inputs as zero, because you will not get any strategy then. Okay. So bull call spread, you'll get to see the margin deployed, strategy, target comes, what would be the PNL, stop loss comes, what would be the PNL. Okay. And then just hover around the cursor, you will get to see on what various levels of Nifty, how much PNL you might make, right? And just move the day slider to see if 4 days from the current day, at what level, how much profit or loss you would end up making. So now there are 5 strategies. How will you pick one of them? So long call is something you might not prefer. Okay. Bear call ladder. Now always don't check just for stop loss, always check drawdown. Okay, what is drawdown? Drawdown over here means if market remains in the target and stop loss range, where is your maximum loss, or how much is your maximum loss? Okay, so go ahead with the strategy which gives you a good profit. That is why you're in the market. Better reward to risk, and the drawdown is very less. Is something what you will prefer. And yes, folks, that's how you pick up a good positional option trading strategy if you have any forecast. Okay. You can try out manual building from architect tool as well. If you want to build something manually, you can build it over here and just add and start analyzing. Okay. So why this is important for positional trading is because in positional trading, strategy is the key. Okay, because you can't forecast the market that okay, this is going to happen 100% of the time, right? But if you build the right strategy, and because that is mathematics, the chances of it going wrong. Your trend can go wrong, but mathematics can't go wrong, right? So that is the catch over here. So build more time in strategy building, strategy analyzing when you're trading positional options. Don't just randomly buy a call option and just hold it, or don't just randomly short a put as well. Ask the optimizer or ask the architect. If you are building something manually, ask the architect, are you getting a better reward to risk? Then that is a to go strategy. And yes, folks, that was it from my side. Thank you so much for joining me up till here, and see you all in the next video. We will continue it over there. Thank you.